How's it going, Publius?
Doing quite well, Maud. Glad to be back in class. How are you?
All is well here and same. I see that Harry already dropped some questions about wells, and I was thinking that we maybe dedicate this class and expand on wells a bit, or have it to be the topic of discussion. And Publius, maybe we can first of all start with, how did the idea of wells come about? What is the problem or problems that wells aim to solve, and then maybe lastly, what are the phases or the versions or the roadmap that we can expect wells to go about? So we know that now it was announced that wells are being reviewed, or the code for wells is currently being reviewed by contributors, and at a later stage it will be reviewed by Halborn, and then hopefully we'll have version one out there. But maybe we can first of all start, how did this idea come about?
So there's a real problem with interoperability in current AMMs, which Beanstalk has experienced firsthand, and we've experienced while working on Beanstalk, in that using the liquidity that is in a Uniswap pool or a Curve pool for the silo has not been such a simple process typically. And this has to do with the amount of information that is stored on chain in those various protocols pools. And in short, the perhaps very beginning of the need to implement a Beanstalk native DEX came from that specific problem, that in order for Beanstalk to be able to use liquidity in a given liquidity pool, it needs certain information, and that information was not typically easily accessible to the protocol. And given the nature of a Curve factory pool deployment, for example, even there have been many discussions in the past on adding other liquidity pools, and how in particular the current structure of Curve and Uniswap limit tremendously the amount of assets that can trade against Beans and be used within the silo. And so that was the starting point, where there was some need to implement, at least at a minimum, a Beanstalk native DEX, or a DEX that would support natively a Beanstalk integration, such that the silo could accept the deposits and minting can take place off of the liquidity in the pool. And what that evolved into, and in our case, we are not really interested in implementing tech that is going to be used one-off and then thrown away. The goal is to implement stuff that is sufficiently generalized and of sufficient quality that it's reusable in perpetuity. We don't want to be doing work that is in practice, in the grand scheme of things, meaningless. We want to be doing work that is helpful to where we're going, because there's so much work to do to get where we're going, that the question is then, how do we get there? And the DEX is a major part of DeFi, and the current state of DEXs in general, aside from just not being particularly easily integrable into Beanstalk, current DEXs are lacking at best, and therefore, well, maybe not therefore, but let's talk a little bit about where they're lacking. So, in particular, the decentralized exchange as a concept is where trading activity happens. And if you think about what it would mean for DeFi to ultimately compete with TradFi, the ability to trade in a competitive venue to centralized alternatives is a necessary part of the puzzle. And current implementations of DEXs, even the state of the art or top of the line, whatever you want to say, Curve, Uniswap, they are not even close to being able to compete with traditional finance trading experiences. And to a large extent, this is because of the nature of the networks that they trade on. And there may be two problems. One is that there's a cost to updating orders, which is expensive for market makers. But more than that, the concept of miner extractable value, whereby if there is a potential profit to be extracted by the miners of the network, in order to if an order wasn't processed, or an update to an order wasn't processed, or a transaction isn't processed, then in theory, the miners should be the ones that can extract the value associated with that transaction, as opposed to the person that wants to pay to execute the transaction. And so then the question is, well, how much would the person be willing to pay to execute the transaction? Up to whatever the miner extractable value is. And so maybe you have a happy middle ground where there's some split or fee between the miners and the users. But in practice, the existence of MEV makes it such that you really can't update your orders. You're not going to be able to update your orders. So if you're a market maker, this becomes a major problem, because from a theoretical perspective, what market makers are really trying to do is maximize how much non-toxic flow they receive. And non-toxic flow can be thought of as directional trades that express a direction in the market, meaning people are buying and selling not for arbitrage, but actually to buy a given asset. Those directional trades are considered non-toxic flow, and are the flow that market makers want to maximize exposure to. You juxtapose that with toxic flow, which is effectively arbitrage. So there's some mispricing in a given market relative to the market at large, and toxic flow can be thought of as the trade that gets the market price back to the market price back to the price of the aggregate market. And if you think about the nature of current AMMs, they rely on the latter, which is toxic flow. They rely on arbitrage in order to maintain their price at the market price. So while you can reasonably expect the price that you're getting on Curve or on Uniswap to be very, very close to the market price, the way that the price in the pool is actually maintained relative to the market price at large is typically some arbitrage or trading against the market. So these markets assume or require toxic flow in order to offer a competitive price to then potentially receive non-toxic flow. But the problem for market makers in these liquidity pools is that the updating of their orders to avoid toxic flow. So if the ETH price moves on centralized exchanges, there's no actual way for them to update their prices in the liquidity pools on chain without exposing themselves to MEV, at which point they can't actually prevent themselves from receiving the toxic flow. And so there have been some pretty good Twitter threads over the past couple months on the toxic flow problem in AMMs, and in particular how it's really not profitable to provide liquidity to these AMMs. And if you think about, again, the goal being for decentralized finance to be able to compete with traditional finance, if market makers cannot profitably make money by providing liquidity on decentralized exchanges, it's unlikely that these decentralized exchanges are going to acquire significant amounts of liquidity, and liquidity begets more liquidity, et cetera, et cetera. And so if the market makers that are providing the initial liquidity cannot make money, then it's going to be really hard for DEXs to accrue the liquidity necessary to compete with traditional finance. So again, the two problems are, one, the cost to update orders, but the real problem is that the orders cannot be updated in practice in order to avoid the toxic flow. So with this in mind, and the fact that it was necessary for a new DEX to be implemented, or at least an updated DEX to be implemented in order to support Beanstalk, wells became a necessary project. And with all of this in mind, the basic idea behind wells, or what wells should be able to support, are arbitrary liquidity pools. And what that means is that the prices over which the assets that are provided to the liquidity pool can be exchanged for other assets can be arbitrary curves, meaning they can have any sort of pricing curve on them, which is tech that was originally developed for the pod marketplace. But B, and this is where the answer to the MEV problem comes in, the inputs to the curves themselves can be arbitrary. So they can be functions, they can be data, on-chain data, such that in practice, there is no need to ever update an order unless a strategy for providing liquidity has changed. Because the wells themselves should support the ability to encode entire trading strategies in a single well, where the liquidity effectively and the prices that the liquidity is willing to be traded for within the well are changing in real time. And by real time, I guess we mean block time. So whenever a trade against a liquidity pool happens, the trade is obviously taking into account the current state of the network on which the transaction is being mined, and it's being traded against the well, and the well itself is also taking into account the current state of the network. And so there is, at least in theory, the ability to encode in wells sufficiently sophisticated strategies such that toxic flow can be, or exposure to toxic flow can be deeply mitigated. So it's not to say that you can get around all the toxic flow, but you can get around a real chunk of it. And that's the basic idea behind wells.
Okay. Publius, I'm going to try to summarize what you just described. And what you're describing as toxic flow, is it correct to call that impermanent loss?
No. So to clarify, impermanent loss is the change in the value of liquidity provided to a liquidity pool based on the change in the price of the pool. Toxic flow has to do with the nature of the trade itself that moves the ratio in the pool. So a liquidity provider could receive impermanent loss from toxic flow or from non-toxic flow, but they're actually different.
Okay. All right. Let's maybe then try to expand on toxic flow. So when the price of an asset changes, and because the AMM does not rely on an oracle, it just relies on a ratio of the curve in it, and then the price of an asset changes. So then you rely on arbitragers to bring down the price or the ratio of the pool back to the market price. And when that happens, this arbitrage is the toxic flow, in the sense that the liquidity providers lose some value or a value of their asset, in the sense that they sell it maybe less than what the market price is. Is that correct?
Well, in this example, the toxic flow is the trade that brings the AMM price back to the market price, because the market price has moved and there's some risk-free trade that can be made by an arbitrager to sell. Let's say the price moved down, so you can sell it in the pool and buy it on a centralized exchange. So there's no risk in the trade, assuming that you execute the trades at the same time. And in doing so, you move the price in the AMM back to the market price. That's toxic flow, because there was no need for the trade to take place necessarily, but the trade taking place is is the AMM giving up a bad price. So the market price has already moved, and now the person that is collecting the arbitrage is getting like a price that is by definition better than the real price, and that's what makes it toxic flow.
Okay. So let's take an example, and say we have a USDC ETH pool, for example, and then that pool is on Uniswap, and then the price of ETH increases, in the market, but that's not reflected in the pool yet. So then arbitrageurs would come and buy the ETH for cheap because it's still cheaper than the market price, until the pool balances in a certain ratio that then the price of ETH becomes equal to the market price. This trade, or these trades that move the price or the ratio of the pool to bring the price of ETH back to the market price, is toxic flow. Is that correct?
Exactly. And if maybe it would be helpful to juxtapose that against non-toxic flow, which would be if the price in the AMM is at the market price, and there is some trade in the AMM where price discovery is actually happening in the AMM. So the market price is already there, and now the person that is trading against, or the user that is trading against the AMM, is actually contributing to price discovery. That would be an example of non-toxic flow.
Okay. And maybe we can also quickly go through how current AMMs work. And in a way, they just follow a certain curve, and that curve depends on the ratio of the two assets, or maybe if there are multiple assets, or the two assets that are in the pool. So Uniswap curve and the likes of current, let's say, AMMs, or the popular ones, is that they don't use any oracles. So the way that they find out a price, or they find price discovery, is just basically purely upon the ratio of the two assets that are in the pool. And then Wells, as you described, is that it won't only rely on just a pricing curve. It can have arbitrary different inputs that then determine what the price of the assets are. Does that mean that then Wells will require an oracle, Publius?
So not necessarily. In fact, and we'll get to talking about the implementations of Wells, but the first version of Well will just be a basic Bean ETH pool, constant product pool that has all the same problems associated with it as Uniswap or Curve. Now, it's worth saying Curve v2 is an attempt to integrate a couple things that we're saying. Curve v2 is an attempt to integrate an oracle into the pricing function, such that the AMM can actually move based on other data, in this case, the oracle, but it's not particularly generalized. And the other thing that's worth commenting on is that there is probably an upgrade to the network itself, in this case, Ethereum, that would really help in terms of MEV, where if at the beginning of every block, oracles were updated before transactions were sent, that would enable the integration between these AMMs and their oracles, and basically get the lag, or the potential toxic flow from a lag in the oracles updating down to zero, because the oracles would be updated at the beginning of the blocks. But to talk more about just Wells themselves, the concept is the Wells orders in Wells can be a function of oracles, but the oracle doesn't necessarily need to be off-chain data. So in particular, when you think about the Beanstalk economy, there's all sorts of data that exists on-chain with regards to Beanstalk that may in fact be the thing that determines the prices of the orders. So if you imagine like a stock pool where stock is being traded, the price at which people are willing to trade stock may be dependent on the silo yield, or may be dependent on the price of a bean, or may be dependent on a variety of other things that stock is a derivative of in many ways. And therefore, if the data exists on chain, you don't have this this Oracle delay problem. But in the case where you want like the price of Ether on all markets, that would be something that would be much better if the Oracle was updated at the beginning of the block as opposed to at random times, or like in Chainlink's case, it updates the Oracle price depending on the distance of the ETH price from the last price. So if it moves like half a percentage point or something like that, I believe is the way the Oracle works. So there is built into those types of ways to update the Oracle some acceptable lag or acceptable misinformation, let's call it, which could be mitigated entirely through an upgrade to the network.
And then in theory, is the idea that wells can, or the price of the assets that are traded in the wells be a function of multiple, let's say, inputs. So one would be depending on the ratio of the assets that are in there, and also the depending on the price oracle. So it's multiple inputs.
In theory, that is possible. Although what's more likely to be the case is that a well is loaded up with one or more assets and then given curves over which those assets can be exchanged for other assets. And the curves themselves take in, let's call it oracles or other data over which to process. But it's like the nature of wells is such that each well will be unique to the set of curves over which things can be traded. And therefore, like the way you were talking about it almost makes it seem like it's one big well that is being updated from an oracle, as opposed to that may be how people experience trading against wells or trading through wells, because the liquidity is aggregated in Aqueducts. But at the individual well level, it's more likely that the orders themselves are somewhat taken effectively arbitrary inputs and process them at the individual curve level.
Okay. Want to go back again to the example of the USDC ETH pool, and maybe say how will that be like in a well. And the reason we're using USDC here is just the idea that we're imagining a hard peg, or USDC is always equal to 1. And in this example now, we go back again that the price of ETH increased, or it went up. Would this well then in theory be able to reflect the change in price and also account the ratio of the different assets? And as you said, it will be the input will be one thing, but that one thing could be a function of multiple things. So it will first of all look at what is the price of ETH, and then also check what are the ratios in the pool, and as a liquidity provider, how much of ETH I have left, and then also what is the price of ETH, and then eventually gives a price to the traders or whoever wants to trade against the well. Is that an accurate?
Yes, that would be possible. Now, it's just worth saying that there would have to be some oracle with the price of Ether that the well is using, but yes, that is certainly possible.
Okay, all right. From here, maybe then Publius, we can go to talk a bit about the oracles, or how do you imagine, or we imagine wells will utilize oracles. You said it, or you're thinking that it can be any will it be first of all any arbitrary oracle that can be used, or sorry, before going to the oracles, maybe we'll ask another question. Will the liquidity providers to a well have and choose their own inputs into the same well, or will each well have a set or a predefined way on how it calculates the prices, and then everyone that's providing liquidity into that well will follow those rules?
It's the latter. So each well is effectively the encoding of a strategy, and that strategy can be arbitrary, as we've already discussed, but it's not going to be that multiple strategies are added to the same well.
Okay, and then do you imagine that a trader would, you will find an aggregate of those, the same asset across multiple wells, or will the trader have to choose
Correct.
a well? All right.
Well, the trader shouldn't. The trader can specify the wells they want to trade against, in theory, but that would be a pretty horrible. The hope is for Aqueducts to aggregate the liquidity that can be accessed and for people to just trade against all of the wells at once.
Okay. All right. Going back now to the Oracle topic a bit, and you touched upon it a little bit, with the MEV discussion. How do you foresee, what kind of an Oracle do you foresee wells utilizing, and how will that be used, and maybe what are the current challenges with oracles in general today?
So, from our perspective, it's unlikely that the Beanstalk native wells, or the wells that use the wells that are providing liquidity for the silo, are unlikely to need oracles. Now, there's an interesting question that is posed here around what will be the acceptable well to deposit in the silo, and if a well uses an oracle, would that necessarily prevent that well from being used to deposit liquidity into the silo? And I think to some extent it's unclear, but it's unlikely that the use of oracles would prevent liquidity from being added to the silo. It's just that the oracles will be used to derive the prices that the wells are willing to provide in given circumstances, which is distinct from any sort of centralization that's introduced into the system itself. So if, let's take a bean ETH pool, for example, or a bean ETH well, where the ratio of beans to ETH that the well is willing to offer is a function of the price of Ether, there is an interesting question as to whether or not if the source of the price of Ether is coming from somewhere else, like Chainlink, for example, whether or not that's acceptable to the silo. And at this point, don't think I have a good answer to share. So that's something that will have to be considered in the future. But the general idea is that the well should support anything. Okay.
Maybe we can discuss a little bit now on the roadmap of wells. So what is the current version that is being reviewed and we expect it to be launched, the V1? What features can we expect in it? And then what is the roadmap that you expect? So what will be V2? Is there a V3?
So the thing that is currently under internal review is the core functionality for wells. And in order for wells to go live and be integrated with Beanstalk, there still remains pumps. There has to be a pump implementation completed, and the integration with Beanstalk and the pump has to take place. So it's not that all of the code necessary for a well's deployment within Beanstalk is done, but the majority of it is done and is getting prepared for audit with Halborn. And due to the composable nature of this, the pumps really are a separate piece of code, although they're obviously related. And the Beanstalk integration between the pumps and the wells is also separate. But this was the big chunk. And in practice, maybe it would make sense to call this like a V0. My understanding is that the only curves or pricing curves that will be included in this Wells core launch is a constant product formula, one that takes 2 assets and another one that takes n assets. And the constant product formula is not the most sophisticated formula that exists for AMMs. And more than that, as we were talking about before, the hope is that people will ultimately deploy custom trading strategies in their own wells. But the V0 well should support a Bean ETH well on a constant product, which will not require any oracles and therefore will be exposed to some toxic flow. And that's what V0 looks like. beyond that, the hope is to have a variety of different pricing functions implemented into wells and a variety of pump implementations beyond the V0 pump implementation that will be used for the silo integration. And so over the next couple of months, the hope would be that the sophistication of orders that can be supported by wells increases. But to some extent, we don't necessarily intend to do all of that development. The hope is that the MVP is there such that the integration can happen with Beanstalk, and then all of the architecture is there for people to go on and create their own additional bells and whistles to their orders that they want and create very sophisticated orders if they want. But that's probably not work that it makes sense for us to do, and instead just kind of leave it out there for the world. But over time, the hope would be that wells support all of the different pricing curves that are popular today in DeFi, and then over time, maybe a library of different curves or pieces of curves that people are using will get built or aggregated such that people can pretty easily plug and play into using a bunch of different curves and composing them together for different assets and such. But at this point, really just focused on getting over the finish line to try to get a Bean ETH pool back up and running within Beanstalk, which from our perspective is very, very important given that currently all of the liquidity that trades against Beans has some centralization exposure to it. And ETH really is the best asset for Beans to be trading against on Ethereum. So very, very much focused on getting the MVP over the finish line.
Okay, and Publius, we spoke a little bit about pumps and aqueducts, but can you maybe tell us again or summarize what are these and how do they fit in, to the overall well architecture?
So pumps are, every well will include a set of pumps, whereby the pumps are the thing that encodes the data on chain such that the liquidity in the pools can be used by other protocols. So if we go back to the very beginning of class where we were talking about how Uniswap and Curve liquidity pools, factory pools, don't lend themselves to being easily used by other protocols, the concept is that each protocol may need certain data from a well, and anytime a well is deployed, it can be deployed with an arbitrary set of pumps that encode the necessary data. Now, the encoding of necessary data on chain is very expensive, and therefore the pump implementations should only be used if the liquidity needs to be used for a given purpose. And in short, the different pump implementations, pumps can be pretty generalized. So you can have like an exponential moving average over different times, a geometric moving average over times. You could have an interest rate pump that determines the interest rate of a given product or something, or from a given well. So there's a wide variety of different things that the pumps can store on chain, but the basic concept is that each pump will store or encode a very specific type of data or piece of data on chain. And aqueducts are the aggregation layer for wells, where you may have a well that provides liquidity in USDC, and that USDC can be traded against a bunch of different assets. And then you're going to have a bunch of different wells that all have different orders for different assets along different curves. And at the end of the day, if you're a taker, if you're trying to just trade against liquidity, the only thing really that you want is to know how much can I get for trading my ETH into USDC, for example. And so Aqueducts is the aggregation layer over which the information or the assets that are stored in wells and their curves will be aggregated in order for users to be able to understand what is actually available to them, even if what is disjoint across a variety of different wells, the Aqueducts will provide a clean interface for the aggregation and querying of that data.
Okay. Before moving to another topic that's out of wells, maybe we'll give it a few minutes and see if any of the audience have any more questions about wells. Otherwise we can move to another topic.
And see that Harry asked, when do we expect the audit to be complete? We don't know yet. Probably something like 4 to 5 or 6 weeks of audit time once they actually get started, and so that probably puts us at sometime late February.
Yeah, because just to be clear, the audit didn't start yet. It's currently in review by the contributors.
Correct. And so even if the audit starts tomorrow, which it may or may not, there's a weekly call with Halborn tomorrow. I'm not sure if the devs have or will be able to get through all of their review prior to that meeting tomorrow. But even if it starts tomorrow, it's probably going to be at least 4 weeks or so, maybe 6 weeks, maybe 8 weeks until the code has been audited by Halborn. And then thereafter, I think there's been some discussion on a code arena audit of wells. And so it's still going to be a little bit of time likely until the code is deployed on chain and integrated with Beanstalk. And as we also mentioned earlier, there is some other pieces of code necessary for that integration with Beanstalk to be implemented, including pumps. And so we're still probably looking at late Q1, early Q2 for actually deploying this within Beanstalk. But this is the completion of the core wells architecture is very much a huge step in that direction.
Okay, and I see there is a related question by Chai Kitty that was posted maybe some time ago, and I can read it, and maybe we can see if there's an answer to that, Publius. So the question is with regards to the AMMs in the sense, or wells, in the sense that what would that or the wells be like that are deposited or like are whitelisted into the silo. And here is a question, and maybe we can start with an example. So let's say that you want to add $1,000 of LP into the silo at some certain price point or price curve that that well arbitrarily chooses. And then the price of bean is different or changes according to because the price of bean fluctuates, let's say. Then that well would offer a different price than other wells that are whitelisted in it. How will Beanstalk take into account that when it comes to seigniorage and seeds as well?
So the first question is around BDV, and then the second is around seeds per BDV. With regards to the BDV question, the wells themselves will effectively imply a bean price. So if you load up 1,000 USDC and you're willing to buy beans at $1, the system should credit you with 1,000 BDV. Whereas if you're only willing to buy beans at 95 cents, the system should credit you with 95 cents on the dollar, so 950 BDV. The basic idea here is that the value of the liquidity in the pool is only good to Beanstalk because it's being used to buy beans. And therefore the question is, well, at what value are those beans being purchased? Now there is an interesting thing here where in practice the $1,000 buying beans at 95 cents actually buys you more than 1,000 BDV. But the point is that the liquidity is being provided for someone to trade against. And so if you're willing to buy beans at 95 cents, someone that has one bean can actually only receive 95 cents of value against that. And so the we think it makes sense to credit, have the silo credit depositors of well tokens based on the value that the well itself is pricing beans. Now, there's a really interesting question here around, well, what if the well contains multiple assets and is willing to buy and sell multiple assets along multiple curves? How to handle the seeds? Think that it probably makes the most sense to have the seeds per BDV be a function of the asset that is actually being held by the liquidity pool, and that may change over time. So someone may load up USDC into a well and give it curves over which to buy beans, which then you get a BDV credit for if you deposit it in the silo. But it may also have a curve over which that USDC can be exchanged for ETH. And if someone comes and trades against the pool and takes out the USDC and adds ETH to the pool or to the well, at that point, perhaps the seeds per BDV of the well should change to reflect the fact that now USDC is no longer being provided in liquidity against beans, and now it's instead ETH. And so that type of update to this, that would require an update to the silo to support really flexible seeds per BDV, but economically that would probably be the most logical answer.
So is it accurate to say that we expect the silo to award, stock or, account for BDV not based on the price of the asset that's whitelisted, but the price of the asset plus, or maybe just, what is the depositor willing to trade it against?
Probably. Now, I think that this is not a solved problem. Don't necessarily feel like this answer is the best possible answer, but it is probably sufficient to launch with. But over time, the system may become more proficient in pricing the BDV of a given deposit.
Okay, we'll pause here for a minute or two. Again, see if any of the audience have any questions that we would like us to expand on wells. Otherwise, we'll move to another topic. Okay, Publius, in the town hall chat, Silo chat linked to a question by Mixolydian, and the question is with regards to governance. And maybe we've discussed this topic before, but here's the question, or the ask. So Mixolydian asks is that should FERT holders have a sway with respect to governance, given that they provided or helped support or seed the current liquidity?
So from our perspective, the fertilizer holders are very similar to pod holders in the sense that they are creditors of Beanstalk. They have lent assets to Beanstalk and are now waiting to be paid back. And from a game theory perspective, it's probably suboptimal for creditors to be able to participate in governance because they are owed something by the system. And in particular, the question is, who should govern Beanstalk? In a perfect world, Beanstalk wouldn't need any governance, but that's not reality. And so amongst the shareholders in the system, you have your creditors and you have your depositors. And unlike the creditors, which have already lent their assets to Beanstalk, and while they can sell their assets on the secondary market, the concept is they are waiting for repayment from the system. Depositors already have the ability to leave the system at any time. And therefore, the expectation is that the depositors are much less likely to vote for something that is short-term beneficial to printing to repay debt, but long-term detrimental to the system, as opposed to if you allow creditors to participate in governance, it's not unreasonable to think that at some point the creditors will vote to have the system do something that ultimately gets the creditors paid back sooner, but compromises the integrity or the long-term sustainability of Beanstalk. And so the basic point is that while it's true that fertilizer holders have been the most recent, or I guess when you consider size, have been the most recent participants in the system, and there is some desire to ensure that the participants in the system are able to affect control over it in a reasonable way. The issue is that the incentives around being a FERT holder or being a pod holder make it such that it's unreasonable to expect the creditors to be able to vote with the long-term success of Beanstalk in mind. And the difference in all cases, the stockholders, the pod holders, the FERT holders, everyone has some expectation of future returns from the system. But the thing that separates stockholders from the creditors is that stockholders can leave the system at any time with their full value, as opposed to lenders are actually waiting for the system to grow in order to receive that value. So primarily it's an incentive problem where it doesn't really make sense for Beanstalk to give creditors the opportunity to vote in governance, because that would potentially jeopardize the integrity of the system if the creditors were voting to ensure repayment in the short term at the cost of long-term sustainability. And the stock system really emphasizes that long-term mindset amongst depositors, where the primary reason to stay in the system is long-term upside, right? If the reason to be in the silo is just short-term exposure, the stock system is less likely to have a meaningful effect on use of the silo in general, as opposed to where the stock system really shines is over longer periods of time. And so given that the goal is for Beanstalk to be able to exist in all market conditions over all periods of time, it's important that the voters from an economics perspective are also aligned with that incentive. And so it's a combination of, you don't want creditors voting, and the people that you do want voting or have voting are already, from an incentive perspective, long-term aligned with the protocol, or at least should be.
Okay, and Guy expands on this question and asks, do you think that the concept of being owed by Beanstalk is somewhat true for unripe assets as well, although they aren't creditors per se? So while it's true that unripe depositors could withdraw at any time, they feel, or Guy feels, that the argument that they could or would vote on the short-term interest in mind is also true to some extent.
Definitely. It's definitely true, and the current setup of Beanstalk is unique in that way, in that a lot of the stockholders are also owed something by the system. But yeah, it's a very good point. It's just at scale, that's not the way the system should work. And so, yeah, we kind of have to just deal with the current situation as it is, but keep in mind what the optimal situation is at the same time. But it is important to acknowledge right now, Beanstalk basically owes all participants.
Publius, would you say that this to an extent was addressed by scaling stock, hence, unripe holders stock changes, and it wasn't, just equal to what was the amount previously?
I don't think it was it's an answer to it, but it is a factor that helps mitigate this issue, but it's certainly still there.
Okay. All right, we have 5 minutes until the hour. We'll pause here and see if folks or the audience have any other questions. Okay, before ending this class, I see that we had a relatively good turnout in today's timing. So to those who are with us, if you think or you prefer this timing over, the regular time that we schedule class, please let us know, and maybe we can have this time to be the permanent one. Otherwise, thank you all for joining us today, and Publius, as always, thank you for taking the time to answer all of these questions. See you next week.
Thanks, man.